It's not what you make, it's what you keep. How different types of income are taxed in Canada. You work hard, you save diligently, and you invest wisely. But when tax season rolls around, you realize your investment income is being taxed at the highest rate. In Canada, not all income is taxed equally. And when it comes to building wealth, it's not about what you make, it's about what you keep. Today, we're going to break down how different types of income are taxed in Canada, how to structure your investments for maximum tax efficiency, and how poor planning can lead to higher taxes and even clawbacks on your retirement benefit. Welcome to the channel. My name is Eric Silvaggi. I'm a wealth advisor with Aegis Wealth Management, a part of Wellington Altus Private Wealth. The goal of our channel is to educate Canadians on the complexities of personal finance and to provide clarity to help them reach their goals. If you're new to the channel, make sure to subscribe and click the like button. Let's dive into the world of tax-efficient investing in Canada. How different types of income are taxed in Canada. Not all income sources are taxed equally. Here's a quick overview of how various types of income are taxed at the top marginal tax rate in Ontario in 2025. Salary income, interest income, foreign income, RSP withdrawals, and pension income are taxed at 53.53%. Non-eligible dividends are taxed at a rate of 47.74%. Eligible dividends are taxed at 39.34%, and capital gains are taxed at 26.77%. So, capital gains are the most tax efficient at this income level. Ordinary income, such as interest and salary income, is taxed at the highest rate. Ranking income types by tax efficiency at a top marginal tax rate. Here's how we rank types of income from most to least tax efficient at high income levels. 1. Capital gains. 2. Eligible dividends. 3. Non-eligible dividends. 4. RRSP withdrawals, pension income, interest income, foreign income, and salary. The takeaway: not all income is created equal, and where you hold your investments matter just as much as what you invest in. Where to hold different types of investments. Let's talk about asset location, where to hold different types of investments to improve tax efficiency in a broad sense. Interest income, typically best in an RRSP or TFSA. Foreign dividends, best held in an RRSP. Eligible dividends, if no room in registered account, it's okay to be held in a taxable account. Tax-free savings accounts are subject to foreign withholding tax on foreign dividends. TFSAs are ideal for growth or interest-generating assets, but not for foreign dividends due to withholding tax. RRSPs are great for fully taxable income and foreign dividends, especially dividend-paying U.S. stocks, which are exempt from withholding tax when held within an RRSP. Taxable accounts are best for capital gains and Canadian dividends due to preferential tax treatment. This is a simplified explanation of where to hold certain assets. When completing true and in-depth planning, we must always consider investment holding periods, deferral, changes to personal tax rate, and registered account contribution room. Common issues with interest income. As a wealth and investment advisor, it's very common for us to see issues caused by interest income. Many people have their interest-bearing investments in non-registered accounts or holding company accounts, leading them to a much higher tax burden. Interest income is 100% taxable at your marginal tax rate, and it's one of the least efficient forms of income. Common sources of interest income include GICs, bonds, high-interest savings accounts, private mortgages, promissory notes. If you're holding these in a taxable account, you're likely paying more tax than necessary. Also, net rental income and private mortgages are taxed as ordinary income at your marginal tax rate, just like interest income. How tax inefficiencies can trigger old age security clawbacks. If you're retired and receiving CPP, OAS, and RRIF withdrawals, tax inefficiency can do more than just increase your tax bill. It can reduce your government benefits. Here's how OAS clawback works in 2025. If your net income exceeds $93,454, you will start to be clawed back, meaning it's reduced. At around $151,668, your OAS is fully clawed back, and you will not receive any. Holding interest-heavy investments in a non-registered account can push your income above the threshold, triggering a clawback. But if you hold capital gains or use return of capital strategies, you can reduce your reported income and preserve more of your old age security. The best investments for non-registered accounts. If you're drawing income from RRIFs, CPP, and old age security, here are the best investments to hold in your non-registered investment account. Canadian equities, eligible dividends and capital gains are tax efficient. Capital gains focused ETFs, low turnover, tax deferral. Corporate class mutual funds, minimize taxable distributions. Return of capital funds provide cash flow without increasing taxable income. Try to avoid holding GICs, bonds, high interest savings accounts. Foreign dividend paying stocks, REITs, and income trusts with complex tax reporting. Why working with a wealth advisor and accountant matters. Tax efficiency isn't just about saving a few dollars. It's about preserving your wealth, protecting your retirement income, and avoiding unnecessary clawbacks. Working with a qualified wealth advisor and accountant can help you structure your portfolio for tax efficiency. Choose the right accounts for each investment, plan withdrawals to minimize taxes, optimize your retirement income strategy. In Canada, it's not what you make, it's what you keep. By understanding how different types of income are taxed and where to hold your investments, you can reduce your tax bill, preserve your benefits, and keep more of your hard-earned money working for you. If you found this video helpful, give it a like, subscribe to the channel, and drop a comment if you have any questions about tax-efficient investing. Thanks for watching, and we'll see you in the next video.